Hello, everyone. Welcome to Net Diligence Virtual Cyber Risk Summit. My name is Heather Osborne, and I'm the Director of Global Events and Programming at Net Diligence, a cyber risk assessment and data breach services company. Net Diligence is pleased to bring our thought-leading content to the virtual space with this new webinar series. Visit our website at www.netdiligence.com to get more information about our upcoming webinars and in-person events. Before we begin, I'd like to extend our heartfelt gratitude to our virtual Cyber Risk Summit sponsors, particularly Aspen Insurance, our diamond sponsor. I'd also like to thank our 100-plus speakers for bringing their thought leadership to our program. For today's webinar, we will be using the On24 platform. Right now, you should be viewing the On24 dashboard, which shows the live viewing screen. During the webcast, all participants will be in listen-only mode. Today's presentation is slated for approximately 45 minutes, with 15 minutes at the end for questions. Our panel of speakers will be taking questions throughout the session via the Questions widget. Please type in questions during the presentation and click Submit. If your question is of immediate import or concerns technical problems, you will receive an immediate answer by text. You can also find a widget entitled Resources, where you can download assets provided by the speakers and sponsors for each webinar. Just click the resource in the box and it will be automatically downloaded. If you are interested in receiving CLE or CE accreditation for this program, you must stay on for the full duration of the webinar and answer 3 polling questions that will appear during the course of the program. Additionally, please fill out the participant information questions. This will ensure that you are correctly matched to the state and professional organization. As a reminder, this webcast is being recorded. After the presentation, you will receive an archive link for further review or for sharing. The webinar will also be available for future viewing on our website. Again, thank you for joining the Net Diligence Virtual Cyber Risk Summit. We hope you enjoy the program.
Thank you for attending the Cyber Risk and Aggregation panel here at Net Diligence. Today we have a panel with 4 persons who will introduce themselves in a moment, and we'll address how we look at systemic risk and aggregation across portfolio, how we measure it internally, who we utilize externally, and really what do we do with the data once we have it. So I'm your moderator, Richard DePiero. I am the Cyber U.S. Product Leader for Sompo Insurance. I've been at Sompo for 2 years. Prior to that, I was at Swiss Re for a few and a broker for about 8. And with me on this panel is Yakir. Please introduce yourself.
Yes. Thank you, Rich. Hello, everyone. My name is Yakir Golan. I'm the CEO at Kovrr, Israeli cyber risk modeling firm.
And Danielle.
Hi, everyone. My name is Danielle Smith. I am Product Manager for Cyber Solutions at RMS.
And Emma.
Hello, everyone. My name is Emma Watkins. I'm Head of Exposure Management, which is part of Risk Aggregation at Lloyd's.
And last but not least, Kelly.
Hi, everyone. My name is Kelly Castriotta. I am the Head of Product Development for Financial Lines North America at Allianz Group.
Thank you very much. So we will go to our first polling question. We'll start with the softball today. Has your company experienced a cyber attack that has affected business? We'll go easy with yes, no, and we'll give the broad not sure. We'll give you guys 30 seconds to answer. So here's our agenda. We're going to address the impact of risk quantification. We'll talk about the current approaches in the market. We'll talk about machine learning and AI and really what the end goal of cyber risk quantification is. So I think to give an intro, as U.S. Cyber Product Manager for Sompo Insurance, the task to understand aggregation potential for cyber risk is where my tinfoil hat wearing tendencies meet reality. From thinking about several potential large loss scenarios its likelihood, its severity, and how that impact can affect my portfolio introduces a level of uncertainty that's unacceptable from a risk management control. Without defining and having insight into the scenarios that affect my portfolio, how can I inject cat load? How do I buy reinsurance? Or how do I exclude cover or coverage for loss scenarios that I don't intend to cover? And that's just addressing my affirmative cyber portfolio. Taking a step back in a broader view, where do we start the task at hand to address the systemic cyber risk when we review other lines of insurance where cyber can be or is silent, inherent, like property, GL, D&O, aviation, crime? This is a large task at hand that needs a broad internal mandate to manage and certainly needs external help. Fortunately, we have people on this panel who are part of the process who can help us provide a more clear picture of exposure and how to get the process done from there. So Danielle and Yakir are our modelers, Kelly is our wording expert, and Emma has experience that can help us navigate this approach as head of exposure management at Lloyd's. So with that, Emma. So Emma, as the Lloyd's systemic risk and aggregation manager, how are you defining systemic risk in a broad manner, and then how are you tracking that aggregation across multiple lines, across multiple syndicates?
So these risks that we're concerned about are risks that have the potential to impact multiple insureds in a significant way and multiple market participants, so multiple Lloyd's syndicates at once in one event. And these cause strain on operations, such as claims, liquidity, when we need to pay lots and lots of losses, all in a very short time frame, and capital. So, we are concerned, where we might be concerned about the longer-term financial stability of the market. We assess and review aggregations for all lines of business, and we start off, I guess, at the syndicate level. So each individual syndicate does its own work to monitor and review these. And then we collect data that we can then aggregate to a market level number.
Right. And so where did Lloyd's start out? We see this outline of the cyber strategy in front of us here at the slide. What were the first steps that were taken to quantify actually cyber risks?
So, yeah, we started in 2012 as specific cyber coverage were being introduced in the market. Lloyd's introduced a risk code, which meant that syndicates report the premium that they collect for those coverages separately. We introduced a cyber risk code, CY, and that meant that any premium collected for cyber was reported, and we could therefore track the premium. To some extent, premium is reflective of risk, so this was a great place to start. But in 2014, we then introduced a realistic disaster scenario for cyber, which was pretty simplistic compared with the sort of things we do today and compared with what we do for other lines of business. It required syndicates just to aggregate their largest exposures in that specific class and report those. But it meant that we not only could track premium and the growth of the market in a commercial sense, but we could also track potential exposure. And we could see how bad the downside could be if a major event were to occur and how that grew or got worse over time. The slide shows how we evolved our strategy and approach since then. When we first asked syndicates to report their own RDSs, we asked them, what are you concerned about and how are you managing the risk? What do you think are the key possible major risks and what might your losses be? And then later on, we added some Lloyd's defined scenarios so that we could aggregate them across the market and get to that market level view that we need in order to stress test Lloyd's own financial criteria and capital.
And so it seems like it was a little bit of a bottom up and then that leads to irregular reporting. So with you pushing down those scenarios, you're really getting a more uniform look throughout all your syndicates and your aggregate exposure.
Yeah.
So, Kelly, Emma has defined, the push-down approach. Now it comes to you, our wordings expert, and you actually have to push those scenarios into your forms. How do you apply those scenarios to your affirmative cyber? How do you apply to those to your silent or non-affirmative scenarios? How do you deal with, a loaded question here, but varied policy wording from, I've seen Bermuda property wordings to London property wordings to your primary to your excess. How do you even start that process?
Great question, Rich. So, definitely it's a tedious process, but taking a really close look at the policy wording across the enterprise is a prerequisite for measuring the accumulation or setting an accumulation framework. So I think the first thing that I would advise to do, that my org did, is to have a clearly defined bucket of what we are measuring here as far as a cyber peril or hazard or however you want to define it. And then from there, you really have to catalog all of the product wordings, not only the offerings that you have, but those in the pipeline, and then how those offerings can be combined and packaged. And that requires a lot of tedious work. And then you test the scenarios that the modelers have developed or claims have helped develop against those wordings. And from there, you can come up with some broadly defined categories of the type of financial losses or property losses that these types of scenarios will produce. And then from there, you can ask, is there a systemic risk, and how do we capture it? And there's really, that gives us two broad ways of sort of capturing this. One is the underwriting solution. So whether it be additional premium or a rate adjustment or wording solutions such as exclusionary wording or affirmative wording or sublimiting. And then the other piece of it would be systemic tracking. So if this is a rate-bearing sort of issue, are you allocating premium to that exposure, and are you coding it consistently across the enterprise? And so from there, you can begin to measure. So the contract wording, bears on the underwriting, bears on the premium, and then from the premium, you can begin to measure accurately and bring the data that you have at this level, very granular level, back up into the modeling.
Are you finding any surprises in policy wordings of scenarios that business groups you're walking into thinking it's excluded and then saying, well, it might be here? Are you closing gaps, or how are you handling that?
I think that there are a lot of surprises because, from my perspective, I come from the financial lines background where we house our cyber standalone policies. So a lot of underwriters that I work with in this product line understand broadly the cyber exposures. But once you start to go into more traditional product lines, I've realized that, across the enterprise, we're speaking different languages. So I think there's a huge advantage if you anchored the discussion on the affirmative standalone cyber policy and you create your categories, your definitional categories from there, so that, for instance, Marine doesn't automatically think of cyber exposure only as social engineering. They begin to see that there's, the data component, business interruption, et cetera. So I really think it's important to have that cross-disciplinary dialogue.
Yeah, and I think there's acceptable levels of cyber and other right? Some cyber coverage may be inherent. I think D&O is probably one of those. Is that fair? Mm-hmm. Or in some scenarios? Sorry.
Absolutely. And so then it becomes a matter of, is this really a different loss, or is this an aggravated loss, as opposed to something that you just wouldn't anticipate whatsoever? Yeah, there's definitely a spectrum.
Yeah. Let's push to the next slide. Emma, we've talked about some of your evolution of your scenarios at Lloyd's. Can you please talk to us about this slide and how Lloyd's is looking at at aggregation and systemic risk from cyber today?
Yeah, so you've seen how our strategy has kind of evolved over time, and in 2019 we published an update to our cyber risk strategy, and as part of that we recognized that we needed to update the scenarios that we were pushing to the market and in the top-down sort of approach, and so we embarked upon a project to update those. What we need for scenarios is scenarios that are extreme and that impact a swathe of insureds and multiple syndicates, as I said, but are realistic and not completely impossible. We need scenarios that are prescriptive enough to be aggregatable across syndicates. We need scenarios that can be completed by all syndicates and that don't require such sophistication that some may not be there yet. We need scenarios that are up to date and reflect the changing landscape, changing threats. We need up-to-date methodologies. We need methodologies that can be updated in the future, and we want to be transparent about what we're asking for. So we convened a group at Lloyd's. We got all the model vendors and a number of brokers, which we were really pleased about. We were really pleased that all the model vendors came and shared this with each other and with us. And we did a workshop to decide upon what are the most relevant systemic cyber threats, and what were the kind of scenarios that we should develop into our new reporting scenarios. So we landed on a revamped blackout scenario. We had a blackout scenario before, but our new one is a scenario that impacts 36 states of the USA, so it's pretty extreme, and it's driven by an attack on transmission infrastructure. We have an updated cloud service provider hack scenario, which we call Cloud Cascade, and that's a cascading outage across infrastructure, platforms, and software, so that businesses around the world suffer business interruption and data loss, amongst other things. And our third scenario is now a ransomware contagion scenario, driven by the increasing prevalence of those sorts of attack. We've published those scenarios at the end of April, and there is detailed information available. People can contact me if they would like to see it, about how the loss event develops, how losses go through to the insurance lines of business, and how probable we believe those events are.
That's great. And I think by using the vendors, I think that's a great segue to our next panels on when syndicates, when insurers are bringing those vendors in. And our second question, our polling question for our panel is, in your opinion, which of these scenarios is most likely to cause the largest systemic loss for insurance carriers? A power blackout, cloud outage, or a ransomware contagion? And we'll give you guys 30 seconds. Okay. So Yakir and Danielle, and Yakir, can you help us understand? Emma brought us in and explained that they're bringing in outside vendors such as Kovrr and RMS. When you guys are brought in, what level of cyber risk modeling are you seeing when you engage with insurers?
So we've seen quite a range of capabilities, and I can happily share that we see great progress on all fronts. So both from mature players and the newer entrants, and the scenarios that we've been asked to model are split into two. So unsurprisingly, Very frequently, we've been asked to model scenarios that are aligned to the Lloyd's RDSs, and mainly the cloud outage and the viral ransomware attack. And on the other side, we are getting requests quite frequently to create ad hoc and develop scenarios specifically to carriers according to their portfolio's composition and according to their appetite. Having said so, we do see more and more demand for a holistic approach, which is scenario-based at heart, but has much more flexibility in modeling known unknown events and scenarios, and also having and providing ability for self-tailoring scenarios.
So would you say the Lloyd scenarios that have been put out are usually kind of your starting point for most carriers and then added on, or is the starting point a little different than that?
Definitely. Many players are asking to start with these scenarios, and I would say roughly half of them do ask some additional scenarios that are tailored to them specifically.
Good. So Danielle, when the carriers are approaching firms, what are you seeing of the commonalities of a more mature cyber risk aggregation management? What are kind of the commonalities of struggle?
Yeah, absolutely. That's a good question. From the clients that we've been working with, a lot of them that are more advanced down the road of cyber risk modeling, they typically are the ones that are asking a lot of questions of the potential insured. They're the ones that are collecting the most data that they can get their hands on. A lot of times they know that this data may or may not turn out to be useful, but they're collecting it, they're trying to analyze it and understand it. They're comparing it to the results of models that are being put out to help try to figure out what has this predictive element and what doesn't. So they're doing a lot internally on their own to try to understand the risk in addition to using a model vendor. However, there are definitely struggles that we see people having as well, and a lot of that is around the exposure data and the lack thereof. This really is a common struggle, not only to cyber but broader as well, that they may not get the exposure data that they want to help them. So therefore, I mean, there are some things that we can do around data enhancement and trying to get that data when they don't have it, but that's definitely a struggle. Another one is potentially a lack of understanding as to what they're actually exposed to, especially when we're talking about non-affirmative or silent cyber. So understanding what the policy actually covers and what it doesn't cover, and looking into exclusions and trying to model that. And this is definitely a good thing to do, especially if you can stress test those exclusions. But those are definitely some of the struggles we see people going through.
Yeah, on the carrier side, as a product side, and I think Kelly can agree to this, understanding and going through policies and applying different coverages to forms that you may not be entirely familiar with is stressful, and it's a lot of work. And then how do you track that? Do you say, well, it might work, it might fall in coverage, or it might not? So it's certainly a struggle I've experienced, unfortunately.
I agree with that, Rich.
Yes. The GL, the energy, it gets, my tinfoil hat gets additional layers consistently. But when we as carriers approach risk modelers, I think it's a little difficult for us to understand where they're coming from. We hear top to bottom or top down. We hear bottom up. Danielle, can you help us understand what's the difference in approaches?
Yes, absolutely. If we could actually advance to the next slide for this. There are a couple of different approaches out there when we are modeling cyber. So typically, the two common ones that people talk about are top-down and bottom-up. So just to quickly highlight, top-down modeling is typically where you start at the top at the industry level, and you sort of determine what losses you think these events or loss processes are going to have at the industry-wide level, so at the very top. And then you take those loss numbers and you sort of filter them down to the bottom and break it up by loss process, break it up by coverage, et cetera, and filter those numbers down. A lot of times this is done using expert advice both on the peril side and the insurance side as to what, say, insurers expect to see an RP200 level loss at the insurance level, at the industry level to be. And that really is sort of a first step. A lot of times if you're looking at the very beginning of modeling, that's a first way that people try to do it. The other way is bottom up. And this is exactly the reverse. So it's going right down to the bottom to the peril itself and saying, well, what is it technically about cyber that is at risk, and how does that risk work? So what vulnerabilities are in a computer system and how widespread is that vulnerability, and then how does that aggregate up to, well, actually just one insured to start with, and then all of the insureds to the industry level. So really going right the other way. Typically, bottom-up modeling is considered to be a better method of modeling because it's more scientific, it's more accurate. You're assessing the actual threat to the system using what is actually there, versus going from the top down is just, I mean, it's not necessarily picking a number out of thin air, but you are saying, well, I expect to see this number, and then working that number backwards, versus bottom up saying, well, we know these are the vulnerabilities, we know these are the risks, how do we then build that up to the top? So bottom up modeling is definitely a more thorough method, and this is really where we've moved to now. Cyber modeling we've moved past the top-down approach, and we're definitely stronger and moving to a bottom-up methodology, as most NatCat modeling is as well.
Okay. So I think with that, what are the main scenarios you are focusing on, and how did you develop them?
Yeah, great. So the slide that we are looking at right now, this shows the 5 RMS IT loss processes. So when we say IT loss processes, this is information technology. This is what you would typically think of as a cyber event. So we see data exfiltration, cloud outage, DDoS, contagious malware, and financial theft. We also model cyber physical as well. So what we mean by that, I'm not going to go in depth today about it, but what we mean by that is physical loss from a cyber trigger. So for example, the Lloyd power blackout would be something that we consider to be a cyber physical event because it's a physical damage from a cyber trigger. However, today I'm going to stick with these traditional IT loss processes here. So just as a sort of high-level methodology of how we develop these, we absolutely use bottom-up modeling, as I was just discussing. But right here to explain how we think about this, I'm going to sort of start the other way and work my way down. So what we see here are, we have 2 rows of bubbles, current annual cost and scalability, split up by our 5 different loss processes. Now what we're looking at is, relatively what loss processes are taking the most loss today, and then how can they scale up to, say, the higher level return periods of loss. How bad can each of these really get? And we see that today, data exfiltration is taking most of the loss, as well as a bit from contagious malware. Actually, that contagious malware bubble could probably be a bit bigger. We've seen some increases in that. And that makes sense. It sort of feels like, you can't go a month or so without hearing about another data breach. But when we look at the scalability factors of these loss processes, data exfiltration doesn't scale all that well, actually, it's definitely not the biggest bubble. And the reason for that is that it's really manual. To steal someone's data, you actually need someone physically at a computer hacking into the system to steal that data out. So you can only really scale it by as many people as you can have doing this. Where contagious malware we see is definitely our biggest bubble, and that is because it's completely automatic. Once you write that code and you release it into the wild, a human being doesn't touch it again. It just goes by itself through the wild. And that really makes it hugely scalable with a lot of ease.
Can you talk about the theft? Because I think that's one scenario that we haven't seen too much about, but how is that, can you address that loss scenario?
Sure. Just very briefly, I can address. So financial theft, this is looking at really the hacking into financial networks and stealing money. So whether that's targeting the SWIFT network, whether it's targeting ATMs, it's really looking at trying to hack into banks and the transfer of that money between banks and finding some flaw in that system that you can utilize to steal money and divert it from where it's supposed to go.
Okay.
Great. Yeah, so the slide that I'm on right now, I'm going to talk about contagious malware because as we saw in the last slide, the contagious malware bubble, that was our biggest scalability factor. So this is the one that has the most possibility to cause widespread damage. So if we look just at contagious malware, we see here on this slide where that can break down by different mechanisms throughout the EP curve. So we see at the lower end of our EP curve, this is really driven by mal spam, and that sort of makes sense. Spamming doesn't really seem like it could be that scalable. Through the mid-level return periods, we see a lot of backdoors driving those mid-level ranges, and that can be dependent on the market share of the software that that backdoor is put into. But really where we see the highest return period losses are going to come from worms through the mid to upper level return periods. So those worms themselves, that's really where we see this aggregation risk coming from at the high level return periods. So if we look into worms a little bit deeper, this is just talking about how we model worms specifically. So fundamentally, when we want to model something, what we're looking to find is the loss. So we model three types of loss: liability, business interruption, and non-business interruption. When we say non-business interruption, we mean things like recovery costs or notification costs. Anything that is not BI or liability broadly gets clumped into there, but we have numerous different coverages that fall into each of these categories. So to find that loss comes from an infection, in this case, a worm. So when we start thinking about this worm, there are a number of different things that can vary worm to worm on a specific basis. So the first, looking just at that worm, would be how many machines are actually vulnerable to this worm? Does it have a hit list? What's the scan extent or interval? Does it have a kill switch? Varying each of those will differ worm to worm. So that's really something that we have to think about and understand. The next step is the detection. At what point is this malware detected? Is it found right away and you're able to shut things down? Or does it sit there for 2 weeks before anybody even notices something's wrong? Those are going to be, different results. And finally, on the response, both from the individual company, are they able to patch or disconnect from the network? And from the community response, are there researchers that can find a kill switch or somehow slow the propagation of this worm? And so all of these different elements combine in their very specific way to cause that one worm. And so that one specific worm in its way is our infection, what we're actually looking to model in this specific instance. And when we think about the infection, what we really care about is, does that malware get into the network? And if it does get into the network, what proportion of the network becomes infected? And that helps us to find our loss. So that's sort of a really high level, how we think about this, how we develop it. And of course, we do all of this with the consideration of cyber experts and insurance experts, and it's all constantly reviewed. But yeah, just as a high level, that's where we are. So I'm going to turn it over to Yakir now.
So Yakir, same question. What are the main scenarios that you're focusing on? How did you develop them, and help us understand Kovrr approach?
Definitely, I do want to touch a bit about the bottom-up, top-down. I think it's a very important aspect. I do want to empower what Danielle said. In Kovrr, we do believe in detailed analysis from the bottom-up, utilizing data that closely corresponds with geography, industry, type of business, and technographic data of the risk. And by taking this approach, we can build an understanding of the core causes of a single event and determine whether it can affect an entire portfolio or a treaty. And by looking on these atomic components of the hazards, service providers, technology, we believe we can best represent the footprint of an event. I'll give you an example. So if we don't need to take and make assumptions on how much physical damage there will be, the actual details of the technology involved will describe the type of disruption possible, including the presence of a physical damage potentially. So in short, a bottom-up approach allows for a more accurate description of the correlation within a portfolio and ultimately a more accurate description of the aggregated accumulations. But there is a value looking on top-down, and they provide an alternative view of the risk which can be used to validate the model and in some cases to improve it. So for instance, when estimating a service provider outage, our bottom-up approach requires us to have a good grasp of which risks in the portfolio rely on that service provider, for example, and in a specific location. And this information not necessarily and is always available. So we had to look for ways for estimating it. And by taking a top-down approach, we were able to identify common traits by geography, sector, and company size. And the top-down approach is also very useful for validation. So often we have only a very high-level view of the impact of historical events, and that high-level view can then be broken down and compared with the model output. Bottom line, I would say that clients need to be aware that top-down approaches, as they are subject to a fair amount of basis risk, they need to be aware of them. And if the portfolio is not aligned with the macro view of the loss, there is a chance of getting the analysis quite inaccurate. In terms of, and I'm jumping and talking about the scenarios and the approach in general in Kovrr, I would say that in Kovrr we believe in an impact-based approach, and therefore the impact of any type of event is inherently included in our event catalog. Our framework, which is the basis for the scenarios creation, is based on extensive analysis of characteristics of historical cyber risk events, cyber incidents from the last decades, including triggers, propagation, and impact, which we bought and continuously buying from various security vendors. And this analysis brought us to the understanding that accumulated losses in cyber are driven from two angles. Service providers, as I guess you're not surprised, single point of failure that going down, telcos, ISPs, cloud providers, affecting many insureds, and on the other silo, technologies. What we call technologies, what we understood is that we are not just looking and interested in commonly used technologies that are highly spread within organizations. We do look for them, but the key is to find also the angle from the attacker side and understand which attacks have what we call virality factor, that they can proliferate automatically without any human interaction. And that's what allowing us to create a catalog which is based on known historical events, but also known unknown events, and thus provide a comprehensive baseline for simulating losses for portfolios.
So, Yakir, that's a really interesting point where you talk about known and unknown losses. You know, typically we'll hear a lot of carriers and a lot of insureds talk about the lack of cyber data and the immaturity of models, and really how some of that data is only available for U.S. clients. But how do you get that the unknown unknowns and the known unknown into your modeling?
So that's a fantastic question. So I would first approach the second part of your question. So in terms of looking on the known known and known unknown, so the known known you're building from looking on incidents continuously from the world of cyber incidents from all kinds of security vendors. And this is serving as the baseline to create the framework. And with that, we're able to look on the known and define the known unknown events according to the technology and service providers a high-level methodology which I share with you. And in terms of to the question in terms of the access to data and access to data on a global basis, not just in the US. So I would say if we're talking about claims data, then I would agree that most claims data available indeed in the US, most of the market, the premiums are indeed in the US. Having said so, with the amounts of claims data exist, just using claims data is not, I don't think it's statistically valid, and we need to find more information from a broader range of sources, and this is available on a global scale. So, for example, information about cyber attacks and financial impacts, including PR costs, legal fees, incident response, it exists. And it's not easy to consume it. You need to find a way to get the data, buy the data, and properly label it and structure it for the insurance industry. But it's out there, and this is the companies that can do that at global scale. I think they have a great edge there.
Great. So, Danielle, how does your modeling develop over time? You know, if we wake up tomorrow morning and a new Eternal Blue exploit CIA weapon is now being propagated across the world, how do you incorporate that in? Do you also how also do you look at, for example, we talk about the blackout scenario. How do you look at the standard industry, let's say in this case, infrastructure controls, and how does that reduce frequency severity? Because I think it's known that it's a concern in that industry.
Yes, absolutely. So just to start talking about if something comes out tomorrow, something's happened, how often do we update, and how can we get that into the model? We can absolutely do that. We update our model at a minimum of a yearly basis for pretty much that reason. Cyber is changing so quickly that what was true last year is not necessarily true this year and going forward. So we do have to update it on a very regular basis. Often it's more than once a year. However, there are a couple of things that can be done. If something happens tomorrow and you want to model it, chances are we actually have something very similar to that in our model. We actually have more than 3,500 events in our event set of the model. So there's likely going to be something that matches this already. So you can do that. Also, our clients can create bespoke models in the software. So they can take a look at those incident rates and costs, et cetera. And if they don't quite like it, they can shift it, especially if they're looking to recreate a historical event that has just happened. Additionally, we have a great consulting team that can do anything like that. So there are a number of things that we can do, and we do aim to update the model quite frequently to take into account these new events that are happening over time.
Yakir, how do you guys handle that?
Yeah, I would just start with a statement that in cyber history repeats, and our approach is a robust catastrophe modeling framework that allows us to gain unique insights into how attackers behave and what methods and blueprints they are using repetitively. And I'll give you an example. So in March, information about the vulnerability in the Microsoft SMB protocol, the notorious Microsoft SMB protocol, was accidentally leaked, and the vulnerability that was known as SMB Ghost affected, as far as I remember, close to 50,000 vulnerable servers just in one day. And why I'm referring to that, Eternal Blue was very similar, that caused these notorious ransomware attacks in the past, leveraging pretty much the same vulnerability as SMB Ghost. And when we look at cyber incidents from the last decades, there is interesting trend around cyber incidents that affected a large set of businesses simultaneously. Attackers use similar blueprints that leverage similar types of vulnerabilities to launch highly distributed attacks. So one of the reasons that these types of events reoccur stems from the fact that many companies around the world rely on similar technologies, similar service providers, and we do need to be able to understand the similarities in these events and to, with that, properly model it.
Yeah. So when we're looking at something like that Northeast blackout, is it you're taking into consideration the controls and the integrated technologies in that industry? Is that a fair statement? So if we magically saw all these entities using, let's say behavioral-based AV rather than signature-based AV, or everybody's using multi-factor to log on, are your severity levels and frequency levels going to be going down in that segment, or is that not affected?
I would say it's fair to say, but when we talked earlier about bottom-up, top-down, at the outage, it's more leaning to the top-down approach, and there, I would say, it's kind of a balance between how much and which kind of services and technologies are relevant. So it's kind of a mix over there.
Yeah. When you guys are running these scenarios, I'll use the loaded term of machine learning and AI. How are you using it? And we can throw out Monte Carlo as well. How are you using these technologies to help bring to life these models? I guess I'll point it to Danielle first, and then we'll go to Yakir.
Sure, great. So I think machine learning can be a really useful tool, especially when we're talking about research and the collection of data. So trying to enhance the amount of data that you have available to you, machine learning can be great to do that. We actually have what we call a cyber incident database. This is our own internal proprietary historical database of cyber events. And we actually have a team that uses machine learning to do web scraping, to collect information about events that are happening throughout the world. And this can be compiled into this database of historical incidents, which is fantastic because it means that our historical database is growing every single day. They're finding new incidents that have been reported somewhere in the world, and it's being collected. And this is important to us because this historical database, we use these historical incidents in our model and to underlie and parameterize our model. So from a research and collection point of view, machine learning can be excellent.
Yakir?
Yeah, I just want to add that from as how I see it today, machine learning has a great, I would say, importance in the world of cyber risk modeling, and it's more, I would say, around the data cleansing and augmentation. So we see great value on leveraging AI, machine learning, to augment firmographic data based on exposure database that we have in-house that we continuously acquire. We use it to map hazards in terms of technology, the technographic data when it's lacking and not necessarily have access to full mapping. So then you can build all kinds of advanced clustering and understand which kind of technologies can be in specific region, industry, by the specific diversification of the portfolio. So we see great value in that. We are definitely all in on that.
Yeah. Are we missing anything as modelers? Are we limited? Are we limited by our reliance upon technology interdependencies? When I think in coming back to my small world of cyber, one of the areas where we feel like we just don't have enough visibility is that non-IT vendor, the supply chain where we talk maybe a FedEx or ports, and the systemic risk that comes with an outage at those companies. Is that something that either one of you companies have looked at? Is it something that we've tried to tackle, or is this just one lens that we're not there yet, but we'll get there hopefully with time?
I would say that this is where machine learning has a great importance, and when you have lack of mapping on whether it's internal processes, whether it's technology service providers that you don't have access to mapping, which all of these are crucial for having the most comprehensive view of the hazard and then creating the simulation. That's exactly where machine learning, and I'm connecting to the previous question, has a great value. So it will never be 100% accurate, but we're seeing some very good results over there, and definitely we see continuously that also the clients, because they understand there is a gap there, also demanding this kind of functionalities and capabilities.
So, we've talked about, and pointing back to where Emma started at this, we're looking at other models from other lines of business, whether flood or wildfire, and applying that to systemic risk in evaluation modeling firms. I guess, Kelly or Emma, are there any advice that you have of lessons learned as you've gone through this process? And I guess Yakir would like to contribute as well. Sorry.
This is Kelly. So I'll just say that the process at Allianz Global Corporate Specialty has been ongoing. I'm not sure if this is replicated in other organizations, but what we are attempting to do is model the risk in stages. First get an accurate sense of what is involved on the affirmative standalone cyber, and then move to financial loss that may not be housed in a standalone cyber product line. And then finally, as Danielle and Yakir had alluded to earlier, trying to tackle the property damage and bodily injury losses. So I think my thesis is that we're using different modeling for different product lines. So yes, traditional modeling has been adequate for property risks for many years. However, there are evolving capabilities, commercial models for data-driven probabilistic analysis for cyber that are relatively well established, and we are using those for standalone cyber exposures. However, the current commercial model capabilities are not necessarily suitable for other product lines, such as pure financial loss coming out of a D&O policy, or even traditional property damage and bodily injury cover. So it's an ongoing process of evaluation and learning about emerging models that are coming into the commercial space.
Yeah, and I'd like to agree. This is Emma. I agree with Kelly's note at the end of there about it being an ongoing process of learning. I think one of the important things that we've learned in our journey of looking at NatCat models is that we started off with NatCat just looking at scenarios, and we made mistakes as a result of that. We got overconfident because we thought we understood these potential damage scenarios, and we thought that we understood the whole of our risk by just looking at these few scenarios. And so we started modeling probabilistically, and then we thought we had a really good overall view of our risk because we were looking at small events, big events, hundreds of thousands of possible events, and assigning probabilities to them, and building an EP curve on them. And we still learned that we didn't fully understand our risk, and that the model is just a model. So I think the key thing I want to make sure that we don't repeat as we go through this process of getting more sophisticated with cyber risk is that we don't become over-reliant on the state of modeling that we're at right now, and that we keep pushing the boundaries and we keep understanding that we don't know everything and that we've still got lots to learn.
That's great news to RMS and Kovrr, I feel.
Can I jump in, Rich?
Please.
Thank you. So I just want to add on top of what the lady just said, that I agree that a lot can be incorporated from modeling techniques from other lines, but At the same time, I think it's important to acknowledge how crucial cyber expertise is in order to model cyber risk. So cyber is a landscape which data is constantly changing, and therefore deep cyber expertise is key. Understanding which type of data you need, how to find the data, how to automate the process to collect the data, how to segment, label it, so you can build a proper model. So you can build and model the proper scenarios according to what's happening out there.
Yeah. Emma, quickly, are syndicates, at least of your knowledge, are they using multiple modeling firms? Are they using single firms? How are syndicates approaching modeler selection?
I'd say it varies. It varies widely. I don't think there's any one trend right now. Well, there is a trend towards investigating models, towards evaluating and validating more and more models. But I don't think anybody is relying on one single model. Everybody, from what I can tell, is looking at scenario losses as a standalone framework and supplementing that with some probabilistic modeling. And in many cases, firms are looking at more than one model in order to evaluate them against each other and then apply perhaps the one that they think is the most robust in the future. But in the most part, I think in our market, the process of evaluating models is still ongoing.
Yeah. So once these syndicates, and I'll speak broadly here, once these syndicates arrive at, let's say, a number for today on exposure of book across multiple lines, what are they doing with that? Are they using that for reinsurance, or what's the end goal of this extremely large task at hand?
I guess there are a number of end goals. In order to the quantification of cyber risk is as important as the quantification of any risk or any of the perils that an insurance firm faces. And there are a lot of ways in which, by understanding the risk, insurers can improve what they do and continue to grow. Understanding the risk, modeling it, or understanding scenarios is really important for technical pricing. It's important for reserving. It's important to the ability to make decisions about outwards or ceded reinsurance, and it's important for assessing capital requirements. Insurers have appetite for risk, but what's important is that people articulate that risk appetite. And once you've articulated your risk appetite, then you can make decisions as to whether or not you've got too much risk, too little risk, or whether you need to offload some of that risk.
Well, great. I'd open up to additional comments by the panel. Otherwise, we're running close to the end of time. Are there any additional comments?
I agree with Emma's statement as to the end game here. I just wanted to add, technical pricing is supreme importance. I mean, I'm coming from the underwriting product perspective, but I think we're all, if I may make a general statement, we're all also trying to affirm the presumption that we're operating and underwriting a risk that is quantifiable, and just getting further refinement is allowing us to improve our product offering and underwrite the risk at the most accurate premium.
Great. With that, we'll move to the last polling question. We mentioned cyber property damage in the call. We had a bit of a discussion on exactly where that coverage should respond. Should that live in the monoline cyber? Should it be in the property? Or should it be in a separate standalone affirmative cyber property program? We'll give you guys 30 seconds to answer. Unfortunately, we've left no time for live Q&A. However, if you've submitted a question to the panel, we'll follow up in an email. Or feel free to contact any one of us directly. Thank you for tuning in. Goodbye.